all of our risk models were powered primarily by quantitative signals. So we're looking at volume, price action, liquidity, depth, all these things across different markets. But oftentimes the vast majority of the time, the driver to all of this type of price action and volatility in the market is news itself. And when news breaks, now we can react to it much faster.
Real fast before we get started in today's fundamental overview, just take a look back at what took place last week. Make sure that all of our minds and our perspectives are clear on what's going on in the markets. Let me meet you guys real fast. For anybody that missed the call yesterday, we hosted a agent making call where I went in and I purchased this AI feature where you can pretty much type ideas into the AI and it will generate you images based off of the key words that you generate, and it'll create you images. And so a lot of us have been interested in creating AI agents, which is outstanding in my personal opinion. I personally think that everybody should accumulate enough assets in order to at least create one agent in the future, even if you don't want to do so now. And these are just some of the images that we had created yesterday with some of the people on the call. I still have a couple of agent messages to go through to create you guys some images. So over the week, I will definitely go through and curate your guys' imagery into the AI agent, or sorry, excuse me, into the AI application and get you guys some images going. If anybody has any AI agent description or image that they want to give to me so that way I can create you guys some pictures, just let me know. These are some of the ones that we created yesterday utilizing the AI. So feel free to reach out so that way you guys don't have to pay for the AI software. I mean, if you want to, it's only like $59 or something like that a month. Or something like that. I don't remember how much I paid yesterday when I bought the subscription because it doesn't really matter, but I paid for it so that way you guys don't have to. You can just send me your description and then I'll generate you guys some ideas and send the images to you. Save you guys some money. So yeah, if anybody's interested in that, I had a couple of people DM me. I still have to get through like 5 people's messages. If anybody else is interested, just DM me and I'll get to you guys throughout the week, create you some images and work with you on any, if the image spits out something that you don't like, just give me some ramifications, some things you want me to adjust, and I'll spit you guys out a couple of images. Alrighty, so in today's video breakdown, I want to paint a very clear picture on what took place last week in the markets and prepare you guys for what is set to come in the coming weeks in the markets, what could possibly take place given the scenarios, risk on, risk off that could unfold, considering the fundamentals that we have on the forefront to be mindful of and pay attention to. The things that we have been talking about in the CYPRX community have proved extremely accurate. We know right now that we are predominantly in a headline-driven environment. And so until that changes, which I don't see happening anytime soon under Trump's presidency, we're going to continue to remain very reactive, and we are going to continue to adapt to the changing market conditions as these fundamental headlines break. Last week was a prime example. So starting on that, last week began with optimism as the total cryptocurrency market cap surged to a weekly high of 3.3 trillion. This was supported by early week risk on sentiment and technical bullishness. However, as we anticipated in our previous briefings and Zoom calls, we warned that if sentiment soured, sellers would likely defend previous positions, potentially triggering a correction toward $3 trillion in the total cryptocurrency market cap. And that exact scenario played out. So just to show you guys, for anybody that missed it, this is our June 2nd call here. On June 2nd, roughly at about 19 minutes into the Zoom call, we had given some overall projections of where the cryptocurrency market was at. And I mentioned that the most likely scenario under risk-off conditions were that buyers were going to get trapped buying from these previous levels and areas of interest of support from previous weeks. And it was going to turn into a lower high scenario, and we were most likely going to see a sharp sell-off down into $3 trillion. Sure enough, this is what we saw. on June 6th, towards the end of the week, that exact same scenario played out. We saw the nice little tiny pump Monday, Tuesday at the beginning of the week, creating that weekly high at 3.3 trillion. Sellers defended from their previous positions. As we anticipated, the market sentiment soured Wednesday, Thursday, with tariff escalations between China and the United States, and also the Elon and Trump debacle that happened. And we sharply sold off directly into that $3 trillion threshold that we had identified days before, right? So, just showing you guys that this stuff remains relatively accurate and extremely important for you to understand, because think about all the misinformation out there, all the bullish moon boy price projections, and all the things that did not make anybody money last week. We here in this community actually made money. Why? Because we waited all week for our strategy to play out before we dollar cost averaged in, or before we took leverage buy positions if you are a day trader. For example, Monday, Tuesday were not buys. Why? Because Monday and Tuesday, the market was in the green. Last week, the market Monday and Tuesday was up 30, $40 billion. That does not paint a picture for us as dollar cost averagers to facilitate buys into this market. Wednesday, Thursday were relatively uncertain. And if you were buying into those days, that's fine, but it did not meet my requirements. My requirements for me to dollar cost average into the market, or at least $100 billion shed from the total cryptocurrency market cap. And so that type of sentiment did not facilitate itself until Thursday afternoon. Thursday afternoon, had you have waited for those parameters to unfold in the market before you entered in, Thursday afternoon presented a beautiful buying opportunity, whether you're a leverage trader or a dollar cost averager, to get in at discounted positions. And now, looking back, had you have bought at those levels, one time, one entry in the market last week, one day, would now present some green in your portfolio, right? And so that is why it's important to block out the noise, because Monday, Tuesday was not a buy. Wednesday into Thursday afternoon was not a buy. And it wasn't until roughly about Thursday evening, when the market fully facilitated that $100 billion shed off, that we actually got an opportunity where we saw crypto fear and greed index below 50, where we saw $100 billion gone from the market, and we saw a risk off market sentiment. Those are the three things that we want to look for in order to build a profitable long-term portfolio. And that really only presented itself on Thursday afternoon last week, right? So just showing you guys the importance of understanding when to implement capital into these markets and when not to, especially considering all the headache that we just saw in the rhetoric from retail surrounding the ZEBIC and XRP, and people selling their XRP for ZEBIC and getting caught in a nasty pullback on ZEBIC and losing money. It's all bullcrap. And instead, just stick to the strategy, stick to proper capital implementation, and understand these fundamentals, and you will most likely outperform 99% of retail traders. So to continue, by Thursday, markets were rocked by renewed tariff uncertainty, escalating geopolitical tensions, and high-profile social media clashes between Trump and Elon Musk, both of which rattled risk appetite. Investors quickly rotated into safe haven assets, and risk assets, including crypto, saw a sharp sell-off. $260 billion were shaved off the total cryptocurrency market cap, and we saw a retracement back down to the critical support of $3 trillion. We highlighted $3 trillion as a key area for buyers' defense, and on Friday, the market indeed saw a modest recovery. So why did the market turn around on Friday? This turnaround was fueled by three critical things. One, we had cooler U.S. labor data that kept rate cut expectations alive, yet strong enough to support the idea that the U.S. economy is not spiraling into a recession right now. Number two, we had de-escalation in rhetoric between Trump and Elon Musk, which calmed the broader market sentiment. Most importantly was the announcement of coordinated diplomatic outreach between the US, China, and Japan, initiating renewed trade dialogues, which allowed for a temporary breath of confidence back into the market. And you can see here in the report, it says, Japan won't necessarily wait for the Group of Seven summit to take place in Canada next week, which happens on the 15th and the 17th of June, remember that, to seal a trade deal with the US if the two sides can agree earlier, Japan's top negotiator said on Washington on Friday. So we had some positive trade rhetoric on Friday, which allowed for a market sentiment turnaround. Okay. We'll get back to this in a second. We'll come back and revisit this screenshot. So now rolling over, all right, what do we need to be paying attention to? What is going on? Let's break down trade negotiations. Let's break down geopolitical tensions, and then let's break down scheduled data. So first, trade negotiations, looking at multiple jurisdictions and what's happening between each jurisdiction and what we need to pay attention to. What could create risk on sentiment and what could create risk off sentiment or more safe haven demand. So, right now, the Trump administration is navigating multiple trade fronts simultaneously: China, Japan, India, UK, Korea, and the EU. His public feud between Elon Musk briefly distracted us from key progress, but behind the scenes, new bilateral talks were initiated. A major overhang is the pending legal ruling on the constitutionality of Trump's use of emergency powers to impose country specific tariffs. This is extremely important. You can see here in this screenshot from the report, it says, the legal fight over Trump's tariffs hangs over everything. A court ruling striking down the country by country duties imposing U.S. emergency authorities left partners with no certainty over what Trump's powers are. The next test could come as soon as next week, when a court could rule on the administration's appeal. So, if the court rejects Trump's appeal, markets may cheer the removal of tariff threats. Inversely, if Trump's appeal is upheld, he could legally reimpose high tariffs, potentially souring market sentiment. So this is something that we need to pay attention to, and we'll briefly touch on towards the end of this report. Trump is under pressure. His 90-day tariff freeze for the EU expires July 9th, and the China reprieve ends in August. The next few weeks are going to be critical. On the Chinese front, Trump secured a much anticipated phone call with Xi Jinping, followed by plans for an in-person talk in London on Monday. That's tomorrow. Okay, so that means tomorrow we need to be very frugal and headline driven, where we need to be mindful of Trump's True Social. We need to be mindful of Twitter. We need to be mindful of Forex Factory releasing this information via Reuters and Bloomberg's terminals. And we just need to be paying attention to any headlines surrounding this conversation that's set to take place tomorrow in London. All right. Trump recently claimed that talks were very far advanced and that Xi had agreed to expedite rare earth mineral exports, a vital supply for U.S. automakers. You can see that here in this report. However, China is maintaining leverage, especially over rare earths. Analysts have warned the progress is overstated, and both sides remain far apart from structural issues. Chinese Vice Premier, I'm not going to butcher this gentleman's name, will also visit the UK this week, adding further complexity to the overlapping negotiations. So you can see here in the report, even though this seems net positive, we're still seeing difficult times ahead. All right, so just be mindful of that. If anything starts to sour in terms of this market sentiment or rhetoric, when they meet in London, it could sour market sentiment and it could weigh on risk assets. We'll get to those scenarios in just a second, but again, just putting that on your radar. On the Indian front, India initially has been seen as a quick win for the United States trade deal. However, that is now taking a more firm stance, especially on agriculture access. Agriculture Minister, I'm not going to butcher this lady's name, emphasized that India will not compromise its farmers' interest under U.S. pressure. A preliminary framework for a deal is expected by September or October 2025. So we have some more interesting dates here, timed with key diplomatic milestones. India's focus is on geostrategic alignment and supply chain cooperation, but agriculture remains a major sticking point. Now, you can see here in this June 6th report, it mentions that this individual from India says, any agreement this month may be a stepping stone toward a more comprehensive deal later on in the year. We know that later on in the year is going to be September and October. So even if we see some type of positive announcement between the US and India, we could still see some uncertain times ahead as we inch closer towards September and October. So just be mindful of that, right? On the Japanese front, Japan continues bilateral trade talks with the United States, aiming to lift tariffs on autos and light trucks. Japan's lead negotiator, Akazawa, reported progress, but no final agreement yet. I highlighted that in bold. Japan may not wait for the G7 summit, which is taking place June 15th to the 17th in Canada, to finalize a deal if consensus is reached earlier. Akazawa emphasized the daily economic damage inflicted by the U.S. tariffs and called for an expedited resolution. So if we come back up here to this report that I screenshotted for you guys, it says, trade discussions between Japan and the U.S. have progressed, but have not reached any consensus on a deal to revisit sweeping U.S. tariffs, he said, after the fifth round of trade talks that included the U.S. Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick said, "We have not found common ground at this point." The negotiations come a week before Prime Minister Ishiba is set to depart for the G7 meeting, in which he said could be a milestone for the talks. Akazawa did not signal that the deal was imminent, but said an agreement will be reached as quickly as possible. So we're still on standby on the Japanese front as well. So it's pretty much like we're on the tipping point of either everything falling apart and shifting more so towards risk off surrounding these tariff implications, or all these jurisdictions meeting frugal, positive trade discussions and us seeing a more risk on market mood as the markets would most likely cheer that rhetoric. All right, so just be mindful. Pretty much every jurisdiction right now is still on standby with major announcements lingering. Okay, so forward guidance to watch. As we head into a pivotal trading week, markets are now hypersensitive to geopolitical and legal catalysts. Here are three primary risk events that traders and investors must monitor. Number one, the G7 summit and trade outcomes. Now, the G7 summit isn't set to take place until the end of the week, rolling over into the weekend, right? Into next week, June 15th to the 17th. So a potential bullish catalyst would be if even one trade agreement is announced during or ahead of the summit, we could see risk appetite increase and crypto markets rally. Inversely, lack of progress or renewed disputes could trigger a fresh wave of risk aversion. So be mindful of that. The second thing we need to be mindful of is the legal ruling on Trump's tariff powers. A pending court case could redefine the scope of Trump's authority to unilaterally impose emergency tariffs. So here, in my personal opinion, would be the market's reaction. If we see the appeal rejected, this would be positive for risk assets, and it would most likely cause less trade uncertainty. So if the court appeals Trump's appeal and pretty much says that the original appeal from the court that Trump cannot impose these high-end tariffs sticks, then the market's most likely going to cheer that, because that would go ahead and markets would start pricing in that all these tariff uncertainties are going to go away to some degree, right? Inversely, if the appeal is upheld, meaning that Trump's appeal remains intact, this could be negative for global markets, especially emerging economies and tech supply chains. So be mindful of that. That's the second thing we need to pay attention to. And last but not least, tariff snapbacks in July and August. If no deals are reached, remember that Trump plans to reimpose tariffs at April's levels, which would be well above the current 10% baseline. That would be significantly bad if we saw an announcement like that jurisdictions have not been able to reach the July 9th deadline. Trump lashes out and he's like, all right, look, mother truckers, y'all are lagging behind. I'm done giving you guys breathing room. Everything that I imposed on April 2nd when the market sold off freaking $300 billion or whatever it was that one single day when Trump announced the April 2nd tariffs, all comes back, and we're just going to see all the optimism unravel, and it's going to be disastrous. So just be mindful, okay? A White House insider did confirm this scenario remains on the table unless major concessions are made, okay? So just be, again, paying attention. A market-friendly outcome would be a revised deal that lowers tariffs even further than what they currently are at the 10% baseline. And then the negative outcome would be if Trump follows through with reinstating elevated tariffs, sending risk assets into another correction. All right. So that is the tariff breakdown. Everything that we need to be mindful on the tariff front. The only jurisdiction that I did not include in this is Korea. So just be mindful of those updates. It was hard to find some documents and some fundamentals on South Korea and what they're doing surrounding tariff implications with the US. Geopolitical risks beyond tariffs. Okay, so we still need to be mindful of any Middle East tensions and the Russia-Ukraine debacle and any flare-ups. There has been a major headline that I just found from yesterday that we definitely need to be paying attention to, and that is the threat from back in March resurfacing that Trump could bomb Iran if they don't come to any frugal negotiations surrounding these nuclear talks. So, while trade negotiations and tariff policy remain the primary drivers of macro volatility, markets must also remain alert to two unfolding geopolitical catalysts that could spark heightened risk aversion and drive flows into safe haven assets like the US dollar, gold, and bonds, potentially triggering a short-term, I highlighted that in bold, a short-term sell-off in risk assets such as cryptocurrencies, because I don't want anybody to think that if this happens, my sentiment flips bearish. Higher time frame, I am bullish on crypto. The sentiment in crypto has never been this bullish in history. Institutional demand is piling in at a rapid pace. We know that these sell-offs usually result in some type of bounce once the market finds its footing or support. So I will continue to see it as such, and any sharp sell-off that we get due to these economic events that take place, I will be taking advantage of those opportunities, not financial advice. So, the Iran nuclear deal tensions. On Friday, US President Donald Trump issued a firm statement declaring that Iran will not be allowed to enrich uranium, despite reports suggesting the latest US proposal might allow low level enrichment for a limited time under international monitoring. They won't be enriching. If they enrich, then we're going to have to do it another way, President Trump said, hinting at potential military action. This veiled threat, which alludes to a possible strike on Iran's nuclear infrastructure, comes at a critical juncture. The U.S. negotiating stance has been inconsistent, frustrating key allies such as Israel, which continues to demand zero enrichment under any deal. Some insiders view the latest proposal as a similar attempt to the 2015 JCPOA Iran deal, albeit with time limitations. And so here is a screenshot of that fundamental report, and I highlighted in red for you all that Trump told reporters, this was at, I don't remember where he was. I think he was in New Jersey getting ready to leave on Air Force One, and he literally turned around to the cameras and said, they won't be enriching. If they enrich, then we're going to have to do it the other way, Trump told reporters, hinting at a military strike against Iran's nuclear sites if a deal is not to pan out. All right. So I highlighted that in red because that would be catastrophic to global risk assets. That would be one of those black swan scenarios where if we started seeing breaking headlines that, bombers are flying over Iran and they're dropping bombs on Iran's nuclear sites or facilities because they didn't come to some agreement, that would be a catalyst that would rock markets, right? And I would just go ahead and assume that it would create a massive demand for safe haven. We'd probably see gold spike up into maybe even new all-time highs, who knows? And we'd probably see a sharp sell-off in risk assets like stocks and crypto temporarily, right? So again, it's not happening, but still something to be mindful of as these negotiations continue to linger. So the escalation scenarios, as I mentioned, if tensions rise and military options are seriously entertained, markets are likely to price in geopolitical risk premiums, driving up demand for safe haven assets. A diplomatic breakthrough is what we would rather cheer and would rather see. So conversely, if nuclear agreements are reached, especially within Israel or the IAEA, buy-in, expect a rebound in risk assets led by equities and crypto. So that is the Middle East forefront. And then also just be monitoring any major attacks between Israel and Iran that could obviously spark a flight to safety. Outside of that, we still have the Russia-Ukraine conflict, which it seems as though the market is pretty subdued on pricing this information in. So we did see a couple of headliners last week that didn't really have too much of a negative impact on the markets, albeit still something we need to be mindful of. So meanwhile, on the Eastern European front, the Russia-Ukraine conflict remains a simmering source of volatility. Recent Ukrainian drone strikes targeted Russia's bomber fleet, prompting threats of retaliation from the Kremlin. While Putin's response has so far focused on heavy bombardments of Kharkiv and Kyiv, U.S. intelligence officials and Western diplomats believed a more severe retaliatory assault is imminent. So I highlighted that in bold for you guys because if that were to happen, it could be something that the market has not priced in yet. Here's a snapshot of that fundamental report where one senior Western diplomat described the expected response from Russia as a huge, vicious, unrelenting attack. And that has not taken place yet. So if we saw some breaking headlines where this escalated further, it could obviously, of course, drive some intraday demand back to safe havens. All right. So just here are the market implications on that, right? Very simplistic. If Russia launches a large-scale retaliatory strike with broader regional spillover risks, expect a sharp flight to safety intraday, likely dragging down risk-on markets. Inversely, what we would like to see is de-escalation or ceasefire talks. Any credible ceasefire initiatives or diplomatic movements could reignite investor optimism, boosting more demand for risk assets intraday. So, as we head deeper into June, these geopolitical developments alongside trade dynamics will play a pivotal role in shaping intraday volatility and sentiment flows. Traders and investors should, number one, monitor headlines from the Middle East and Eastern Europe in real time. Number two, watch for market moving language and statements from the White House, Israel officials, or Russian ministries of defense. Not financial advice. As I mentioned, I personally will be using periods of risk off panic as strategic buy in opportunities, particularly if crypto markets correct to key discounted levels. And number three, prepare for spikes, or excuse me, number four, prepare for spikes in volatility that may create both risks and windows of opportunity. All right. So that is it for the geopolitical forefront. So far now we have covered tariff implications, we have covered geopolitical tensions. Now let's roll over into the scheduled data week ahead. So starting with today, nothing on the forefront. Just be mindful of any announcements from the Trump administration on tariff implications or geopolitical uncertainty. Tomorrow, Monday, relatively mute. We don't really have any Fed speakers, and we don't have any scheduled data on the US front, followed by Tuesday with a similar day. So, relatively quiet first three trading days of the week: Sunday, Monday, Tuesday. Things don't really pick up on the scheduled data forefront until Wednesday with our first high impact news event: inflation data in the core CPI and CPI month over month, year over year reports. Thursday as well, we have some core PPI figures to be paying attention to, along with unemployment claims, i.e., labor market figures. And then Friday, we'll end the week with consumer sentiment and inflation expectations, right? So these are going to be our primary scheduled events this week to be mindful of that could create some market volume and volatility depending on how the data comes out. So let's go over this part of the report thoroughly so that way you guys understand the possible outcomes and scenarios. One thing I want you all to be mindful of that I made sure to pay attention to in this report, and it's something that we got right last time, is that even if we see lower inflation, which usually tends to drive a risk on sentiment as the market starts to price in a higher probability of Fed rate cuts later on this year, we could see the inverse effect where even if we see lower inflation cheering rate cut bets due to geopolitical uncertainty and tariff implications creating market uncertainty, driving more demand for safe haven, we could still see sell pressure and riskier assets. So don't marry a bullish bias even if we get lower inflation. Continue to be reactive. All right, so let's cover this thoroughly. As we move into a critical data heavy stretch, the spotlight will be on US inflation figures, labor market signals, and consumer confidence, all while tariff risks and geopolitical tensions hover in the background, threatening to mute otherwise bullish outcomes. Remember that at the end of this, we're going to do our overall trajectory. We're going to take a look at the total cryptocurrency market cap, do some risk on projections, risk off projections, and then we'll do the same for Bitcoin, look at some intraday delta levels, and then we'll do the same for XRP. All right. So, what the markets would ideally like to see for a risk on market mood in terms of the scheduled data this week that we have. Number one, lower than expected core CPI, especially on a month over month basis that would signal continued disinflationary trends. Number two, headline year over year inflation holding at 2.3% or dropping lower, reinforcing bets that the Fed may consider rate cuts later this year. And number three, a scenario that would typically boost demand for risk assets in the form of the markets cheering and starting to price in a higher probability that the Fed is going to cut rates in September. If core CPI surprises to the upside above 0.3%, especially after sticky wage growth or services inflation, it could delay rate cut expectations and pressure markets. Even worse, even a lower inflation print may not lift markets if safe haven demand persists due to tariff uncertainty with China or geopolitical escalations in Iran, Russia, or Ukraine. So that is one thing that I mentioned. Even if we see a lower inflation print, if we see anything else drive market uncertainty, it could overpower the lower inflation sentiment that we would get that usually tends to cheer risk assets, and it could have an inverse effect. So in this case, risk assets could diverge from macro fundamentals as capital flows prioritize safety over yield. All right. As for the PPI figures, risk on sentiment would be driven in the PPI figures if we see a soft or negative PPI print that confirms easing upstream price pressures, reinforcing disinflationary trends across the supply chain. This would support the lower CPI data that we could possibly see and strengthen the case for dovish Fed pivot, especially if labor data also softens. Inversely, the risk-off signal here would be if PPI surprises to the upside, markets may interpret it as a warning that goods inflation could resurface, keeping the Fed in a holding pattern and weakening risk sentiment. So, to full circle all this, an upside surprise in sentiment, ideally in the Sorry, excuse me. I got ahead of myself. So we have the University of Michigan consumer sentiment. Keep in mind. So that is this down here on Friday, the consumer sentiment and the inflation expectations. So going over that part, the risk on signal here on Friday's data would be an upside surprise in sentiment. So ideally, a reading above the 54 threshold would suggest that consumer confidence is stabilizing or improving, reducing recessionary fears. So any figure on Friday that reduces recessionary fears will likely see cheered by risk assets. Markets may interpret this as a validation that the US economy remains resilient, boosting equities and crypto. And then the risk off signal would be any downside miss. So any print closer to or below the 51 grade threshold would reinforce concerns that consumers are pulling back amid macro uncertainty. Weak confidence could counteract any bullish CPI or PPI data, especially if paired with worsening headlines out of China, Iran, or Ukraine. So if the markets start pricing in because the consumer sentiment comes out downbeat, that we're on the brink of a possible recession, that consumers are unhappy, they're not positive and optimistic, and the sentiment's just bad, that could create some downwards pressure in risk assets. So it is important to remember, just to wrap this up, that disinflationary trends alone does not guarantee a risk on rally. I highlighted that in bold because we've experienced that in this community firsthand. Here is why, just to break that down. Geopolitical and trade headwinds, tensions over tariffs with China, unresolved trade deals with Japan and India, or military posturing in Iran and Ukraine could overwhelm positive inflation prints by increasing demand for US treasuries and dollars or other safe haven assets like gold and yen. This dynamic tends to suppress crypto, equities, and other risk assets, despite macro conditions that would typically support them. We are in an environment where market participants are reactive, not proactive. Investors are more likely to fade rallies on good news if headlines signal instability elsewhere. This means that even with a lower CPI and PPI print to the downside, it could be ignored if, for example, Trump ramps up tariff rhetoric or geopolitical retaliation intensifies. So I really wanted to spend some time in this report reiterating that, so that way nobody marries a bias. If we do see a lower print in PPI and CPI, we see a nice little tiny market pump, everybody gets excited, retail starts saying, oh my gosh, the bottom's in, we're going to freaking flip back to the upside. But then 2 days later, the United States bombs Iran and everything falls apart again, right? So the bottom line to wrap all this up, okay, to put it in a nutshell for you guys, for a risk on breakout, we would ideally like to see soft CPI, a lower or benign PPI report, and improving consumer sentiment with no negative surprises on the tariff or geopolitical forefront. This is a formula this week for a short term bullish impulse. And I say short term because the week after could always come with some black swan event. You never know. But this would be the ideal scenario this week to see risk assets continue their uptrend, continue their rebound, and rekindle losses from previous weeks. So let's focus on this scenario first. Let's take this over to the total cryptocurrency market cap. If we see a risk on market sentiment via the things that I just mentioned this week, the ideal scenario for us to see will be one of three things: a double bottom formation, where maybe at the beginning of the week or early on in the week, we see some sell pressure or sellers defending from where they previously sold from at these risk premium areas of interest here. So sellers defending, a double bottom formation, buyers coming back in, defending their positions at $3 trillion, and a move back to the upside. That would be scenario number one in a bullish environment. Scenario number two would be buy continuation breakouts from where we currently stand, buyers overpowering sellers from where they previously existed in markets before, and continuing the uptrend from there. And then scenario number three, we could see a full-on breakout, no retest, bullish implications in the market, positive announcements, and markets making an attempt to come and attack higher price levels to overpower previous sellers that existed in the market from previous weekly highs. The most ideal scenario for us as discounted buy-in investors would be for us to see this scenario number one unfold, maybe some discounts at the beginning or the middle of the week, back down into $3 trillion to get some secure entries for prices to flip back to the upside. On Bitcoin, Right now, I have the most recent two sell deltas on my charts and the most two recent buy deltas on my charts at major key psychological levels. So, in a risk on environment this week, we can go ahead and assume that Bitcoin is going to follow suit with the total cryptocurrency market cap. We could see scenario number one play out where Bitcoin retests the 102 to 103 psychological level. Buyers come back in, reaccumulate orders, and send price back to the upside, correcting more of this previous downside move from previous weeks. Scenario number two, where I'd be looking for some good scalp positions, if not down here at these discounted areas, if I was trading, would be a breakout, a retest of 106 for buyers to show their hand and hold that as a supportive area where you can see it previously acted as resistance to take price up into the next sell delta at about 110,000 per Bitcoin, right? So this would be the two bullish catalysts or bullish environments that I would see for Bitcoin intraday. And if we go higher under a more projected risk on sentiment, then that would open the door for possible higher prices. I think honestly, the next sell delta on Bitcoin doesn't come in until like 116,000. After 116,000, the next sell delta is until 123,000. In order to see something like that, we would need to see a massive bullish catalyst supporting risk on sentiment, right? So for now, let's just take it level by level. The next high level after we breach 106,000 is going to be 110,000, where sellers previously showed their hands. So we would have to have enough bullish impetus in the markets for buyers to overpower sellers that are going to most likely defend their positions at 110,000, right? So these would be the two bullish catalysts for Bitcoin that I could see unfolding this week if we see this scenario here play out. XRP. XRP had a beautiful rejection of the $2.09 psychological level, which has played a very important role for pretty much over a month now. Yep, May 7th, May 5th, the first week of May, the $2.09 level played a very significant role. You can see now XRP sold off. Buyers have now come back in at $2.09 and defended their positions. So just like on Bitcoin and the total cryptocurrency market cap, we can assume that if the sentiment continues positive, we're most likely going to target sell deltas and we're going to remain above buy deltas. So scenario number one, which would be ideal for anybody that missed out on this recent entry at $2.09, would be a retest or a pullback into discount from $2.09 previous and a recovery back up into $2.36, which is where our next sell delta exists, or where we can clearly see sellers previously overpowered buyers in the market, right? Second scenario would be a continued bullish momentum from where we currently stand, a retest of $2.36 and a move higher, possibly targeting $2.76 or these previous sellers here that existed at about $2.63, as long as bullish sentiment can continue, right? These will be our bullish scenarios for XRP. Anything under $2.09, I would just go ahead and assume that that would be curated by some type of risk market environment, right? So with that being said, scenario number two for all of these trading pairs. Well, total cryptocurrency market cap's not a trading pair, but you catch my drift, right? So if CPI or PPI surprise to the upside this week, or if geopolitical risks dominate headlines, Iranian enrichment, Russia escalation, trade war rhetoric, then safe haven demand will likely spike and markets could ignore otherwise bullish economic data like lower PPI or CPI readings that we could possibly get, right? So any of these factors here are most likely going to create a risk off sentiment. And in that case, these bullish scenarios are most likely not going to unfold. And we are most likely going to see sellers show their hand at previous resistance areas or where they previously sold from. That being said, the first area of interest that we would need to see buyers break, if they don't, sellers are most likely going to defend in a risk off environment and push prices back to the downside. That comes in at about $3.3 trillion. Another scenario that we could see, just like last week, where at the beginning of the week we were bullish, and then we ended the week bearish, we could see the same thing this week, where we see a bullish move, buyers trying to overpower sellers. We can see some pent up sell pressure here, where the market makers created a lower high, trapped buyers here at these lows, and overpowered buyers selling off their positions. So if at the beginning of the week we see a bullish move, but then Wednesday, for example, that leads us into CPI, and CPI data on Wednesday when the market's here comes out higher, we can assume that the markets are going to start to push back rate cuts, which usually tends to weigh on risk assets, and that could create a sell-off in global risk assets, where sellers have the ability to come back in, use fundamentals as a catalyst to move the markets, and defend their previous positions. And under worse conditions, anything worse than last week's sell-off, like a major announcement or escalation in attack, super high inflation that excessively pushes back on rate cut trajectory, so on and so forth, any hawkish rhetoric from central banks, so on and so forth. You guys catch the drift, right? We always just need to be mindful that any black swan event or worsening market conditions could still open the door for a major correction down here into the previous May lows, which would send us down into about 2.8 to 2.9 trillion dollars. I personally don't think that that is going to happen. I think $3 trillion is going to hold. However, if at any point in time we did see worsening conditions and we broke below 3 trillion, retested it, and sellers showed their hand, I think that that is going to open the door for us to come straight down into 2.8 to 2.9 trillion dollars before buyers come back in and defend again from previous prices. So just keep that on the radar, right? But for now, these are the two primary scenarios. Sellers defending at 3.3 trillion or sellers defending at 3.4 trillion this week. As for Bitcoin, excuse me, you know what? We'll do XRP first. As for XRP, right now the immediate sell delta resides at $2.36. If we cannot break $2.36, I could see a scenario where we might start to try to poke above that briefly. We can see some resistance here in this area, slightly above $2.36. If sentiment starts to sour, buyers cannot overpower at $2.36. We're probably going to start to do one of two things. XRP is going to consolidate at or around the delta, or we're going to see sellers show their hand, and we're going to see a revisitation of $2.09. That would be the first bearish target. Anything worse than that, we break $2.09 as an example, retest it to the downside. That opens the door for $1.99 as our first bearish target. Anything below $1.99 or any worsening conditions, that opens the door for $1.78, where I do have some buy limits set on XRP just in case they come into fruition. Does not mean that I think it's going to happen, but I'm prepared just in case it does, right? So anything below $1.99, that opens the door for the next buy delta at $1.78, where it would be really nice to get into some XRP positions because you can clearly see that this played a very significant role in the past. And so if we can see buyers come back down here into this area, accumulate orders, we can expect some similar price action to what we got from this area previous, right? But we have to overcome these levels first. So with that being said, $2.09 this week, if the market flips risk off, is going to be our first bearish target. And our second bearish target is going to be $1.99. We'll go from there as we go along. All right. Bitcoin. I think right now on Bitcoin, guys and gals, I'm going to be completely honest with you. I'm bullish on Bitcoin as long as price remains above $97,000. The reason being is because if you go into the Discord and you look at the excessive amount of buy volume that exists at $97,000 per Bitcoin, it is a lot of buy volume here in this area where the market's consolidated for a couple days and then boom, at $97,000, we saw a massive push on Bitcoin all the way back above 100,000. I've noticed that we have yet to retest that level, so I'm paying very close attention to it, where that is the type of level where if we saw some black swan event, I could see us wicking down into 97,000, buyers defending, and then the market recovering. So in a bearish environment, I'm paying very close attention to that level. However, I'm bullish on Bitcoin as long as we're above $97,000. So it's kind of hard for me to give a bearish intraday kind of synopsis on Bitcoin because I'm bullish above this level. However, for you sellers that are in this community, intraday, I'd be looking at these types of setups. So if the market sentiment sours this week, the most immediate sell delta right now exists at about $106,100 per Bitcoin. So if we cannot see buyers create support above that, sellers start to win and show their hand, the most immediate bearish target on Bitcoin is going to be a revisitation of last week's low at $102,000. We could also see a scenario where we revisit the highs at 110,000. You can see here, sellers defended heavily their positions as buyers tried to make an attempt to push higher. They failed miserably and the market sold off. We could see another attempt on buyers to try to overpower at $110,000, but then the market again shows some type of risk off fundamental and we could see sellers defend again. So that would be scenario number 2. And scenario number 3, if any of these things unfold, would be a break of $102,000, a retest to the downside, and an extended move back down to revisit that $97,000 threshold where there is a lot of buy volume on the daily where the market makers could come back in and defend, right? So scenario number 1, a failure to break above 106,000, sellers showing their hand, pushing price back down to the low $100,000 range. Scenario number 2, buyers are able to overpower 106,000 but fail at 110,000. We see the markets reject and start to correct. And scenario number 3, if either of these two unfold, a break of 102,000 opens the door for a possible revisitation of price back below 100,000. My first area of interest, if we break 100,000, is going to be that $97,000 mark. All right. Those are my projections on Bitcoin, risk off environment, but still kind of hard because I'm bullish above 97,000. Like if we revisit $97,000, I'm probably going to put like 20K into Bitcoin. I'm not even going to lie. Not even going to lie. So there's that. All right. Anyways, that is my overall projection this week. Make sure that you guys thoroughly read through this report so that way you understand it via your own perspective and interpretation of it. Outside of that, I'm going to continue to deliver you guys this level of accuracy on a daily and weekly basis. So hopefully this helps. I feel like we are one of the only communities on the internet that delivers these types of detailed reports and paint a very clear picture of what things could unfold in the markets moving forward. Obviously, of course, we can pay attention to any announcements via ETFs or regulatory clarity that could obviously, of course, drive demand for risk assets. Those are all kind of like white swan events that we can't really predict, but would drive market optimism if we did see those things unfold. All right. Outside of that, I'll keep you guys updated. It seems like we're going to have a pretty dry schedule this week for Zooms because we don't really have any data to report on tomorrow and Tuesday. So the only thing that would require us to have a Zoom call is if we see any major headlines that shake or rock the markets that we need to update on surrounding tariff implications. Outside of that, the next Zoom call probably won't be until Tuesday, so that way we can prep for Wednesday's inflation data. All right. Outside of that, that's all I got for you guys. I will leave the floor open for questions briefly if you have any, and if not, I'll let you guys go back to enjoying your weekend, and I'll talk to you guys later this week. If there's any questions, you guys are more than welcome to ask now.